Market Catalyst. I'm Allie Canal. We're 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, President Trump set to address world leaders at the United Nations. We'll break down what it means for trade policy. Plus, analysts celebrate Nvidia's $100 billion investment in OpenAI. We'll discuss what both companies get out of the deal. And we'll look at the pressure networks face from both Washington and their own station partners as Disney announces Kimmel's return. But first, taking a look at the major averages, you are seeing the Dow trading in positive territory, up roughly 0.6%. The Nasdaq is down about 0.4%. The S&P very much flat, searching for direction here after the S&P notched its 28th record close on Monday. We'll see if we can reverse things later on in the session and potentially clinch 29 record closes. But interesting to see the equal weighted index far outpacing the benchmark S&P. This suggests that gains are broad-based, not just concentrated in those tech-heavy names. Speaking of broad-based gains, you're seeing your Russell 2000 move higher. Russell has really outperformed. This is the small cap index. When it comes to expectations of Fed easing, you're seeing record highs there. Year to date, we are up 11%. And speaking of Fed easing expectations, I want to take a look at the bond market. You're seeing yields tick slightly lower today. The 10-year hovering at around 4.1%. The 30-year yield is firmly below 4.8%. So even though we've seen various commentary from Fed officials when it comes to the future of interest rates, with Fed President Raphael Bostic, for example, saying that he doesn't necessarily see further easing this year, you still have markets at least pricing in that expectation. At the very least, that's what the bond market seems to be telling us. But President Trump is set to deliver remarks to the United Nations General Assembly in moments time. On the sidelines of the event, officials from the U.S. and India met as part of ongoing trade negotiations. Secretary of State Marco Rubio calling India, quote, critical to the United States. Joining me now, Matthew McGuire, former World Bank U.S. Executive Director. So, Matthew, Trump set to speak at the UN. We have these trade negotiations with India, trade tensions with China still ongoing, the war in Gaza, top of mind for a lot of world leaders. So how does Trump's speech really set the stage when it comes to where the U.S. is right now in the global world and on that global stage tonight?
What a lot of people be looking for is what exactly President Trump is saying and where he's headed, because what has changed in his administration from previous ones is it seems a much more mercurial or really about him and what he's thinking at any given time. So people hang on to every word because the normal processes for negotiations on trade and other things don't seem to be carrying the day. And you're absolutely right on India. This is a critically important country to us. And right now we seem to be in a real spat with them. Largest country in the world, great counterweight to China, so people will be watching there. But the other thing I'll mention, which hasn't gotten a lot of attention, is just yesterday, the Treasury Secretary said the U.S. is ready to backstop Argentina, their currency and their economic challenges. And he said that's a systemically important country for us. And a lot of people are really scratching their heads. You look at something like Mexico, 3 times larger than Argentina's economy, Brazil, almost 4 times larger. They seem to be getting the brunt of a lot of our antagonism, whereas all of a sudden Argentina seems in a very different place. And that's just a great example of why people are watching everything he's saying to get a clear sense of what's going to happen next.
You mentioned the importance of that partnership between India and the U.S. What will it take, in your view, for those two countries to reach a deal?
There's a lot there that we can work on. And I'll mention that while we talk about the economic side an awful lot, we started a partnership about 5-6 years ago called the Quad, which really is thought of as a way we can counter China's influence in the Indo-Pacific. So that's the US, it's India, it's Japan, and it's Australia. 4 very interesting countries. A lot of the work there is really about national security at this point. But people are watching. If the India-US relationship ruptures a bit, even more, then people are going to wonder what happens to that security relationship. And the two always go hand in hand.
And another flashpoint here is Trump's plan to charge $100,000 for new H-1B visas. Big tech can absorb that, but what does it mean for some of these smaller players, the startup companies, and that talent flow at a time where the U.S. is trying to really maintain that competitive edge?
Yeah, this is an interesting one. There have been people who have been unhappy about H-1B visas for a long time. There are some people who say Americans would do those jobs, and we do have the talent here. It just tends to cost more when you hire someone who's from the US as opposed to someone who's very eager to come here from India or other places in particular. So I think this is going to be interesting to see how it plays out. What I would say is, if there's really a shortage there, this is why we probably need a staggered approach, not something that lands just at once. We need to think about how we can support universities and educational systems to train even more people, but make it something where over time maybe we get to that 100,000 as opposed to doing it all at once, which tends to shock everyone's system and often doesn't have great effects.
And turning to trade policy more broadly, you've said that rate cuts can't fix tariffs, that they're the real chokehold on the economy, but we haven't necessarily seen that flow through into the data. Companies seem to be pretty resilient and finding ways to really circumvent a lot of the tariff burden. So has that been surprising to you, considering your viewpoint there?
Well, I would say the market seems to be carrying on quite strong, and certainly the largest companies in America, 40–50% of their earnings come from abroad. So I would separate that a little bit. I think where we've seen it in the data is the overall economic growth. We went from about 2.8% growth last year to right now we're at about 1.6 for this year. The OECD just put out its projections. They're expecting us to be at 1.5% for 2025 and only 1.6% for 2026. So that's a real growth slowdown. And the other thing I would say is just jobs. So we've seen this with all the Fed discussions, but right now the job market is really not good in America. Most of the jobs that we have gotten, and it's a very small number in the last 3, 4, 5 months, have just been in healthcare and then also in government. So the job market is the area where I think we've seen companies really pulling back and sitting on their hands.
Now, you did mention that OECD report. The organization did lift its U.S. growth outlook for 2025, citing AI. I guess, how do you view AI in relation to the economy, and how do you square that maybe with the tariff drag that could pull growth down over time?
So AI clearly is booming, and whether or not it's frothy, I don't know. I'm not someone who has dug into that or is really an expert on that space. But what I would say is that an awful lot of the growth we're seeing right now is coming from AI, even though it's much smaller than it was previously. But there aren't a lot of jobs there. So when you build a data center, yes, there's some jobs that come in building that data center out, but it's not a great job creator. And AI, of course, we've heard a lot of talk about how actually could reduce the number of jobs in white collar industries and others. So I come back to jobs, and that's the real question is, where is the policy where we're focused on increasing not only the number of jobs, but also the quality of jobs? How many can we lift so that people can really afford a house these days and do all the other things they need? So I look at the jobs in particular, and I think that's the area where we're seeing some real challenges right now.
Yeah, certainly jobs are a big focus to a lot of investors, especially the Fed right now as well. Matthew, thank you so much. Appreciate your time.
Thank you.
Coming up, Firefly Aerospace marking its first quarter as a public company, how investors should parse through those results. That's next on Market Catalysts. Shares of Firefly Aerospace sinking today after the company reported earnings for the first time since going public. Firefly reported lower than expected sales and a wider loss. Joining me now in studio with more on what investors should make of these results is Chad Anderson, Space Capital founder and CEO, as well as the author of The Space Economy. So Chad, I want to start with this investor reaction here. I mean, is this just growing pains to you, or does it perhaps suggest maybe it wasn't the right time to IPO, considering, things aren't too good out there?
Well, there's no doubt that their IPO last month really set expectations high, and that hype is now giving way to an execution test. Light revenue, large quarterly losses in their first earnings is really not the victory lap that investors were hoping for, and I think that the move in the stock price is really reflecting that. But on the other hand, the US government is a powerful growth engine, and there's billions of dollars flowing into national security and lunar programs, and Firefly is well positioned to capitalize on that demand.
Now, we did specifically ask Firefly CEO Jason Kim about profitability on IPO day. Executive editor Brian Sazi was able to sit down with him, and I want to get your reaction here on what he had to say.
We just got awarded our fourth lunar lander contract. It was $178 million. That increased our backlog from $1.1 billion to $1.3 billion. So you can see our team is focused on execution and what they're capable of doing. When we give them the guidance, the support, the resources to do their jobs, they're knocking it out of the park.
When do you think you will hit profitability?
It goes back to we're rating up, and as we rate up and we have more launches and we have more lunar landers and more Electras going up there, we're going to hit profitability.
So Chad, you hear that confidence from the CEO, promising that profitability as they scale, but how much patience, I guess, do investors have to wait that out? And is there even more pressure on them to turn a profit now that they're public?
Yeah, I mean, there definitely is more pressure, and they have a large backlog, but backlog doesn't equal cash. They need to execute now on those contracts. They do their IPO proceeds do give them some wiggle room and some room to maneuver. I mean, they brought in almost $1 billion. So the company is well positioned, and they have real technology. I mean, they operate in a couple of different industries within the space economy. They have a launch vehicle, which is critically important. There is no doubt that demand for launch is the supply of launch vehicles cannot keep up with the demand. So we need more vehicles, and when their vehicle comes online, I think we're going to see it in Q3. The FAA has cleared them since their April mishap. They've been cleared now to fly again, so I think we'll see them start to bring in some of that revenue in Q3 maybe. And then they also operate in the lunar economy and in the lunar industry, which is growing. There's, like he mentioned, they just landed another $200 million contract with NASA. There's a lot of civil interest here from NASA and other agencies, and a lot of Department of Defense and national security interest and money from the Space Force in other places that's going to the moon. Firefly is the only commercial company, privately funded company that has successfully landed on the moon. We saw those beautiful images that they took from the lunar surface last year. So they have real tech and real capability. And I think, they're talking about this is, their miss was really based on milestone payments and like when those contracts are pulling through. We'll have to see how things shake out in Q3, but they have a real backlog, real tech, and now they just need to pull it through.
You're talking about a lot of upside potential here, and yet the stock is down 10%. So is this why we see companies like SpaceX for years stay private, because they want to avoid some of that quarterly pressure?
Well, I mean, so it is a different game to be public, and again, the company, Firefly said that some of their miss was due to just the cost of going public, right? And then so once you are public, a lot of this is happening out in the open, and this is, we're watching innovation as it happens. On the other hand, retail investors have been wanting to get access to startup companies earlier, and there's been a complaint that, companies stay private for so long, and then by the time they go public, there's no more upside. Firefly has a vehicle that is a launch vehicle that's really close, and we hope to see it come online in Q3 and start launching regularly. So this is a company that has a product and has some other products coming online. It's a good time, an interesting time for retail investors to be to get involved and participate in a really interesting company.
Yeah, and does this open the door maybe for other types of space investments or other types of companies to come out and go public one day? I mean, does this set us up for a period where we can finally start investing in space maybe more regularly?
Yeah, so this is all hinges on SpaceX really making space more accessible about a little over a decade ago. All of the entrepreneurship, innovation, investment capital is underpinned by SpaceX and that access. So we're at the point where we're starting to see some of those early companies that took advantage of that, have raised capital, started up with some seed funding, and have now grown to the point where they're ready to go public. We're starting to see those companies come online. I think there is a lot of value in having a discerning eye and not getting caught up in the excitement and the hype of it all, because there is a lot of really shiny objects out there, some of those companies going public, but there's not a lot going on under the hood, right? So it still takes some diligence and some expertise to come in and be able to differentiate between the companies that can execute and those that are really just, selling snake oil. But both companies exist and both are being traded.
And when you look under the hood to find those companies, those diamonds in the rough, so it seems, what are you looking for? What are you concentrated on?
Execution. I mean, for us, we're investing very early. We're a venture capital fund that's investing at the earliest stage and then supporting those companies as they grow pre-IPO. For us, it's really a focus on the team and their ability and their track record of execution. I mean, you can have a $1.3 billion backlog. It doesn't count for much if you can't pull it through, right? If you miss milestone payments, if you continue to miss milestone payments or milestones and you don't get those payments, if you don't execute and the government, for whatever reason, like those contracts go away, you got to read the fine print in those contracts and understand what they need to do. But it really comes down to that basic fundamental principle and ability to execute and do what you say you're going to do.
Well, investors will certainly be watching Firefly to see if they can execute on some of those potential deals. Shares are down around 10%. Chad, thank you so much. Appreciate your insights. Well, Nvidia is investing up to $100 billion in OpenAI, with the first $10 billion coming right after the deal is signed. The chip giant will support the AI startup's data center buildouts with at least 10 gigawatts of power capacity and equipped with Nvidia's advanced chips to train and deploy AI models. Joining me now on this is Sultan Medji, the founder and CEO of Frontier Foundry and former chief innovation officer at the FDIC. And I want to start on this deal, your reaction to it, and how this maybe sets us up for the future of AI infrastructure.
It's definitely one of the most interesting capital investments we've seen in a while, and hopefully will help scale this up in a way where the overall price to delivery goes down. OpenAI's infrastructure set is starting to get a little old compared to other players in the space. So this is a big investment, a big vote of confidence from Nvidia, which obviously makes up the vast majority of OpenAI's infrastructure, and hopefully gives OpenAI the opportunity to continue to find that revenue that they're missing right now.
And so it's interesting because not everyone has been swept up in the optimism. We heard from one analyst, D.A. Davidson Galoria, who said that Nvidia is acting as the, quote, investor of last resort, bailing out OpenAI's extended commitment. So do you view that as a red flag at all?
Well, there are kind of two different red flags, or I'd say at least yellow flags, that are in my mind right now. The first is that we're exiting kind of version one of this generative AI market, and we haven't seen someone hit that Google moment or that iPhone moment where the revenue just geometrically goes up. The second is we're seeing a big separation between enterprise and government utilization of these technologies and consumer utilization of these technologies. And so as the market matures, you can continue to see this kind of fragmentation happen, and newer companies that are more focused, more narrowly defined relative to enterprise value, are doing far more with far less money.
And far less money. According to Bain, there's a new report that AI companies may fall $800 billion short in revenue by 2030, given current monetization rates. So is Nvidia the only one that's making money in this space right now? I mean, when can we expect the others to catch up?
It's a great question, and frankly, right now with this version of the GPU technologies that Nvidia is getting everyone to use, which is in their own best interest, right? Buy my chip and then rent it out to everyone else. It's a great way to alter the spreadsheets and make sure that you're still making money. Everybody on the other end is going to be racing to the bottom in terms of commoditization and trying to get those prices down as much as possible. So, 2 years from now, I would expect to see this market radically altered, and I think a lot of the big data center projects are never actually going to get fully built up to fruition, because this technology is evolving incredibly rapidly, and needing a GPU to run a transformer, which is really what this is about, is no longer required. You can use CPUs, you can use alternative chipsets, and all of that other innovation is coming very rapidly.
And what are the implications of that, Sultan, if we do see that extremely altered landscape from where we are right now?
Yeah, I mean, for the last couple of years, we've seen a massive concentration in venture capital and capital investment in a very small number of companies, while there are thousands of other companies out there that are doing incredibly interesting, high quality work in artificial intelligence on smaller scale infrastructures, whether it's a laptop in some cases, or an iPad, or a single server sitting in a desk, these edge compute use cases. We're going to end up seeing this bifurcation of the market from one version where it's all big GPU farms for very specific large scale use cases, but the enterprise value is probably not going to come from that. It's going to come from people who are using smaller scale infrastructures to drive process optimization, to drive lower costs, to drive better bottom lines, to get to market faster. And I think at the end of the day, the question I wonder is OpenAI, the next Google, or is it the next Ask Jeeves?
So as an investor, what should you be looking at? Should you be looking at some of those smaller players and maybe not focusing so much attention on the big shiny objects like your Nvidia?
No, I have always focused on what's the ROI. Are you going to end up being able to invest in something that will drive a return on investment that justifies the amount of money you're putting in? Right now, there are a lot of companies out there where the ROI is far more straightforward, and there's a far more linear path from I put $1 in now, I get $7 out in a few years. And so, a lot of these bigger, kind of pre-COVID or through COVID AI companies just are very expensive. And frankly, it's not clear that you'll be able to get your money back. Nvidia is always going to be a different case because there's just so much demand right now. But 2 or 3 years from now, I'm not sure that's necessarily going to be the same.
And finally, I want to end on what I've been ruminating on, which is this flywheel of investments. Nvidia, Intel, Nvidia, OpenAI. You have OpenAI, Oracle. What do you make of what's going on in this space right now when it comes to sort of the pockets of money changing within this same circle?
Well, when 70 to 80% of the investment capital expenditure that people are talking about is locked into less than 20 companies, it's really hard to see anything outside of that, right? That little bubble, and you just did a great job explaining it, is this nice little bubble, and all they're doing is trying to keep it moving until they can get enough enterprise revenue to justify the amount of money they've put in yet, and that's not happening at the pace that everyone wants. That little bubble you just talked about is not an area that I find, frankly, that interesting from an investment perspective. And so much of the very interesting technology that's being developed right now is outside of that bubble as well. So if you're really thinking about that, bubble is going to be there, but it's sort of like saying, AWS is going to be there or Azure is going to be there. Well, of course they are, but is that necessarily going to be your high growth market, your high innovation market? I think there's some question there.
Yeah, a lot to keep tracking in this space. Sultan, thank you so much. Appreciate your time today.
Thanks for having me.
Before we head to break, we want to take a look at live pictures from the United Nations as President Trump addresses the UN General Assembly. We'll bring you any breaking news from the event. Stay with us.
Or accept a ceasefire. Instead of giving to Hamas and giving so much, because they've taken so much, this could have been solved so long ago. But instead of giving in to Hamas's ransom demands,
Welcome back to Yahoo Finance. I'm Brooke DePalma. We're live at the NASDAQ in Times Square. Let's turn now to some of today's top analyst calls on Wall Street. We're taking a closer look at Tesla, Lululemon, and Johnson & Johnson. Tesla's stock seeing a small pop this morning after financial firm Mizuho raised its price target to $450. That's up from $375. The stock now around $433. The analyst there said they see a, quote, much more muted U.S. tariff impact. The firm also cited the proposed $1 trillion pay package for CEO Elon Musk, his recent $1 billion stock purchase, and in the background, the growth potential for the robo-taxi and humanoid robot adoption. Next up, we have Lululemon. That stock reversing to the upside just a bit after it did fall in pre-market trading. Baird analysts cut its rating on the stock to neutral from outperform. That analyst cited a low near-term confidence in its margin and growth trajectory after that disappointing second quarter results that came out on September 4th. He also called the recent product innovation uninspiring in the U.S. Now, year to date, this stock is down more than 50%, and it's currently hovering around a 6-year low, the first time since 2019. And Johnson & Johnson stock got an upgrade from Guggenheim to buy from neutral. The firm said it's now comfortable with how the pharmaceutical company handled and navigated the loss of exclusivity for the autoimmune drug Stelara. It also expects innovation around medicine. Well, that could lead to the next phase of growth for the brand. And that's today's top calls on Wall Street. Keep it right here on Yahoo Finance for more on what's moving the markets today.
Now time for some of today's trending tickers. We're watching Better.com, Boeing, and CVS. First up, Better Home and Finance. Shares of Better Home and Finance surged after hedge fund manager Eric Jackson disclosed a stake in the company. The move sparked a rally similar to what we saw with Opendoor earlier this year, which drew heavy retail interest. Better shares jumped as much as 176% Monday, hitting their highest level since August 2023 and triggering multiple volatility halts. The stock is up now more than 460% year to date. Next, Boeing. Boeing shares gaining after the U.S. ambassador to China said a major order from the world's second largest economy is close to being finalized. The company also locked in a deal with Uzbekistan Airways for up to 22 Dreamliner jets. And Bloomberg reports Boeing is working on an even bigger agreement with China, potentially as many as 500 aircrafts. Finally, CVS. Omnicare, a subsidiary of CVS, has filed for bankruptcy after being ordered to pay $949 million over claims that it improperly dispensed prescription drugs to long-term care patients. The company says the Chapter 11 filing will give it time to evaluate options to resolve the judgment and address other financial pressures facing the industry. Omnicare says it could restructure on its own or pursue a sale. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. All your market action straight ahead. Stay tuned. You're watching Market Catalysts.
All right, Nvidia and other chip giants dominate the artificial intelligence space, but there's more than one way to play the AI trade. We're taking a deeper dive into investment opportunities beyond the semiconductor space with the Yahoo Finance playbook. And joining me now is Zeno Mercer, head of robotics and AI research at TMX Verify. Zeno, we said we're going to talk about other stuff. Let's start, though, with Nvidia and what we saw from OpenAI today. We were joking earlier on in the program. I kind of catch myself when I'm announcing the news. It's 100 billion. Right? Like I want to say 100 million, but I guess that's where we're at now. I'm just curious how you think about those zeros. Let's just start there. The scale that we're seeing and the way the market digests news that we're going to see a $100 billion investment, stock goes up 4%.
Yeah, I mean, exactly. It's their money being invested there. So that's kind of funny that we're seeing this a bit circular AI data center economy. But as a reminder, this comes off the heels of a couple of weeks ago, the OpenAI Oracle announced $300 billion deal, which I, among many others, was a bit skeptical of the financing of. So it seems like there might be some in-house partnership engineering to make it happen. Maybe in a way similar to how Microsoft was financing and partnering with OpenAI earlier on. We're starting to see, obviously, these things branch out. Nvidia is facing some headwinds in China, so they're looking for other kind of growth spurt opportunities. That's another thing that's been in focus for us as well. But obviously, this isn't just 100. If let's just assume this $100 billion goes through and they invest, they're not the only people. Like, it's not $100 billion going back to Nvidia. There are a lot of partners involved that will get upside not only from this Nvidia partnership, but all the other AI big data center developments that are happening around the globe, including with competitor products from AMD, even Google TPUs and all those other build outs. So again, there's a lot of players involved in these various ecosystems.
It feels like we're kind of talking, let's say, like the heavy industry part of the AI cycle, right? It's big data centers, it's a lot of chips, but you're thinking about things like robotics, automation, which kind of feel to me, the more I think about it, more I read about it, like that feels like where AI is going to make a larger impact on my life in 5 or 10 years than how many chips are in a data center in Utah or whatever it is. Like, what are those opportunities like, and what are companies, maybe some opportunities you see in those spaces, that robotics, that automation area that is part of the AI trade, but I think just doesn't have the buzz the way some of these mega cap chip related names do.
Yeah, I think it's a great way to look at it, and it's how we've looked at it for a long time. As you know, we were behind the world's first robotics index and ETF that was launched in 2013. So we've always kind of had an eye and focus to that physical automation. And if you look at a similar parallel story of like the silicon build out that we're seeing now, robotics and let's call it the edge and inference of AI, its nexus and polymorphism into the real world, we see a different and more broad-stroked set of players involved. So you obviously have power involved. So you have companies like Infineon and others that are helping, not just help with power utilization in data centers, but at the edge and robots, drones, whatever form factor that appears. You not only have sensor compute limitations and power compute limitations, but form factor. So companies that help get the max value, and that involves like energy, form factor, and quality, that's really going to be the table stakes for developing that next frontier. And obviously, robotic simulations are accelerating rapidly to enhance these capabilities. So, going from sim to real, which is how, the industry phrases it, involves having the right hardware and software stack. So, you kind of get both of that, like that physical automation and digital automation within robo and think strategies. But again, with Ambarella, for example, at one point traded at $200 per share. It's at $85 per share. It's starting to get that inference and edge economy uptick. They got a pretty big partnership with Insta360 for 360-degree camera footage. But if you start to think about okay, what are the next bigger growth factors? It really is that edge intelligence, and it really hasn't been priced in the same way. And these companies are smaller market caps too, so they have more room to grow. And at a certain point, there's only so much money the economy can afford to invest in a specific area. We're kind of in this game theory, power dynamics theory, data center build out. But where does that trickle into? And eventually we'll see more and more of that compute happening on the edge with smaller models and autonomy. But let's not forget that it will be tethered to the cloud. So connectivity is also a big consideration here. And so names like Cloudflare, Qualcomm, and MediaTek are all very important to that more, we'll call it even longer duration, maybe even a bigger opportunity in these data centers. Maybe data center is the biggest investment of the next 2-3 years, but we'll start to see these other areas really take off. And I think earnings season, for example, really started to show more excitement about this, especially we had seen several years of a downturn for the robotics industry, which might surprise many people listening here today.
Yeah, it's interesting just looking at that Ambarella stock chart. It's there's still COVID overhangs out there. Stock's still down from where it was the end of 2021. Quickly, you mentioned hardware, so it made me think of Meta, what we saw from them last week. And I'm just curious how you think about, let's say, the way they're combining their previous metaverse AR ambitions, combining it now, tethering it to what they want to do in AI, and making that all part of one story, and both the technical side of it and then what they hope to be a large consumer side in the end.
Yeah, look, I was never that excited by metaverse as pure metaverse, like virtual reality. It's like most of our lives and really should be in the real world. So I've always been excited about things that can enhance our daily living. Their latest Meta display and neural bands are a step towards that. The SDK is currently limited to their ecosystem. So I think that's something that needs to happen. But long story short, for those that missed it or haven't really known much, they now have these glasses that have a little display that's pretty seamless, high quality display that's there, and you have a wristband that comes with it that you can now control. So you're eliminating the keyboard, the mouse, and my thought is eventually they'll open up the SDK to partners to do things like control things around your home, like replace remotes. And so what you're really looking at is something I've been calling for a while, like the post-smartphone economy, but we've been stuck with our little comfort bricks for a long time now, and we really can move past that. And again, that requires, you look back to Google Glasses, which I had a pair of 10 years ago as like a little demo. I actually wanted at an event, but we've really been hardware constrained and software constrained, and both of those are improving to the point where you can do local and cloud compute and the connectivity on a device and a form factor that is comfortable for a human, not just a robot. But the two have a lot of parallelisms in terms of how they're both combining at the same time to provide real-time, let's call it sense, analyze, and act capabilities. And that's kind of one of the mottos of the robotics industry, is what kind of defines a robot. So again, we are becoming a little bit more cyborg, but also getting kind of like Fantasia-like powers. Now, I don't even have a Facebook right now, so somebody like me, I need to see it connected to other things. But again, there's an entire hardware and software stack of winners that go from the companies helping Taiwan Semiconductor make these chips on the inference side and the edge compute side for a Meta, but also the connectivity and sensors and up and downstream there. So again, really excited about all these different areas coming together, especially as we head to 2026. And I think we're starting to see that pull through in the strategies too.
Yeah, agree. I'm tired of having a phone, but the only solution, I guess, is going to be more technology someday. All right, Zena, we'll leave it there. Thanks so much.
Jimmy Kimmel Live is set to return to ABC after Disney suspended the show last week. But Sinclair, the largest owner of ABC affiliates, says it will still preempt Kimmel and air news programming instead. The back and forth over Kimmel sparks bigger questions about how media companies navigate a changing political climate and whether it accelerates the shift from broadcast to streaming. Joining me now is Keith Valerie, CEO of Plex, the largest independent streaming platform with one of the biggest fast channel libraries out there. And Keith, I want to start on this Disney news. It's certainly been making a lot of headlines. And I'm curious, from your perspective as a media executive, what does this say about the power dynamics when we look at at broadcasting groups versus Netflix versus networks, and then you have the streaming players in the mix.
Yeah, I mean, I've been giving that a lot of thought over the last few weeks. I will tell you that in our business, we are essentially protecting freedom of expression, right? Our vision statement for the company is actually enabling users to connect with content. And I think most companies in this space have those same obligations. So I have kind of two takeaways from it. One is independence, right? We're a smaller company, but we're independent. We are somewhat insulated from the issues that we're seeing today. But I think you can look at, you mentioned Netflix. Netflix is also in a place where they're more insulated from a company who owns a network that may have more regulation. So I think moving towards more independence is going to be something that's important long term. I also just think there's a moral obligation, and I have a level of confidence and I think optimism that these issues actually put out a conversation where we are now seeing media companies have to live up to this moral obligation of, we have to be the kind of gateway or the guardians of the gate, if you will, to protect freedom of expression. So we'll see even the perception of chilling of freedom of expression, whether it's through forcing an apology or something like that, is going to weigh really heavily here. And I'm hoping that the powers that be in some of these companies will see that we really do have to support these artists and make sure that expression is free and open.
And when you compare cable versus broadcast versus streaming, how less restrictive is streaming? Is there more flexibility there, and maybe it's a little more insulated from some of these political pressures?
Yes, absolutely. That's what I was saying. I think for us, we're definitely more insulated. I actually saw it on the other side a few years ago. We had a more conservative news outlet on our program, and there was concerns around election denial and things like that. And there were concerns from the other side saying, you got to take this down. This is dangerous, blah, blah, blah. And we stuck to our guns. There was certainly people that were not happy with those decisions. But I think in our case, there was no outside pressure. It was just, can we make the right decision? And again, I think there are larger media companies that are in that same position. I think what we'll be looking to, and again, my hope is that the powers that be see that we have to kind of take hands off and not exert pressure on broadcasters and other media companies that have much more regulation.
And at the same time, all of this is happening when the landscape is really changing. Late night shows, you've seen the ratings significantly decline. So as we are in this era where there is a shift from broadcast to streaming, how are you seeing that play out in real time through your business, through that perspective?
Yeah, so our business is not tied to that. What we haven't seen in the shows that we program is we're not kind of tied to that late night time frame. And that may be part of it, right? Is that now there's shows like, John Oliver or others that are kind of moving to either a more podcast format or a format that is not necessarily tied to a time of day. And I think that's probably where this goes, right? Late night might have made sense for a generation that was, put the kids to bed, sit down and watch TV, but TV is a lot more fluid now. You can watch it, whenever, wherever you want. So I do think that's an opportunity for some of these artists to move away from those channels anyway. And again, it may be other channels owned within a family of companies like within Disney, but maybe that content actually belongs under a subscription service and an easier to get way. So yeah, I think it's all changing. It's all in flux. But again, I'm optimistic that the conversation that we're having is good, and it feels like cooler heads are prevailing, at least in the case of Jimmy Kimmel. And my hope is that this helps us get to a better place.
But you do bring up a great point that content isn't necessarily going away, but the way we receive it is different. Things are changing. As we continue to sort of assess what works, what doesn't in this new environment, what formats do you think are going to win out?
Well, clearly, I think streaming is going to win out over time, right? We're betting heavily on that. As you know, there's a lot of consolidation in the space. There's a lot of movement of content. There will have a consolidation and then a spin out and lots of do-overs, I think. What we're doing in our business is essentially creating a layer that kind of sits on top of that. Imagine if you went to your TV, you clicked on an app, all of your shows, whether it's on Netflix or Hulu or Disney, are all in one continue watching. You can see what your friends are watching, you can rate it, and you can jump right in. I think that's where the future is going, right? The content has never been better. And some of these apps are beautiful. The Disney app's super beautiful for a bespoke set of content. Netflix does a great job with their app. But the consumer's issue really is how do I get to all of this content? How do I manage it? And I think that's really what we want to solve for the end user, help them get to the content. And then all of the shifting that happens underneath is really less important to the end user, and they can always get to the content that they want.
And Plex has one of the largest libraries of fast channels, free ad-supported channels. Where do you see that in conjunction with some of these more subscription-based streaming services? Are more folks gravitating towards advertising services because they're cheaper, especially at a time when the consumer is a bit squeezed?
For sure. We actually launched our AVOD service during the COVID lockdowns, and it just kind of took off. It was a pretty amazing run that we had on AVOD and FAST. But what we've seen is that's continued over the last few years. And even you'll see the subscription services are adding ads back in. So I think ads are going to be part of the total mix. But do I think it's the only way that content's going to be consumed? Absolutely not. Which is, again, I think our AVOD catalog is one of the largest, and that's great. It's a good monetary source for us, and it's great for our users. When they come in, we can get them that content more quickly. We also have hundreds of free channels. We have thousands of titles that you can rent. So there's a lot of content in Plex. But what we always kind of say that our job is to be the first place people go when they want to get content, and not necessarily the last. So we're absolutely fine if you come in and you see in your continue watching, oh, that show was on Netflix, I want to watch that. Our obligation is to get you to that content as soon as we possibly can, not to try and keep you in and watch something that's in our catalog. So to answer your question, I think there's going to be some of all of it. Hopefully, we'll still have subscription services where we don't have to watch any ads, but there are plenty of great content options where ads are a part of that, and if it results in a less expensive overall cost for the end user, I think that's great.
Yeah, we keep hearing optionality is the name of the game. Keith, thank you so much. Appreciate it.
Thanks for having me.
Well, coming up, full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Coming up this hour on Market Catalysts. First up, we break down the outlook for crypto as digital assets come under pressure. Plus, Citi out with a bullish call on General Motors. We'll discuss with the analyst. And we'll hone in on the state of discretionary spending and discuss the restaurant industry with celebrity chef Andrew Zimmern. 90 minutes into the start of U.S. trading, I'm Allie Canal. Let's get a quick check of the markets. We take a look at the major averages. You are still seeing the S&P 500 trade just below the flat line. The Dow was up roughly 200 points, and the Nasdaq is off about 0.3%. This comes after all three major indexes hit fresh record highs on Monday. If the S&P is able to reverse and trade in the green, it would be on track for its 29th record close of the year. So we'll be watching markets very closely. For now, we are still seeing the S&P off just slightly there. Well, cryptocurrencies still under pressure today after the market had its biggest deleveraging event of the year, with liquidations hitting $1.7 billion on Monday. The move fueling fears of a devastating crypto winter. Joining me now is Zach Pandel, Grayscale Managing Director of Research. Zach, how are you reading this latest sell-off?
On with you again. Look, I read this sell-off as mostly technical in nature. One of the unique things about crypto is the product structure, and we have something that creates automatic liquidations. And so, trader leverage was running relatively high. We had some short-term flow factors that caused a modest pullback in price, and then that extended with liquidations. This is a typical pattern that we see in crypto markets all the time. I don't see anything fundamental behind the move, more just trader positioning related, and I think the market will quickly move beyond it.
And when we talk about some of those technical positions, even seasonality, when do we typically tend to see the most crypto volatility? And how can investors decipher whether this is a fundamental red flag or maybe more technical in nature?
Well, crypto is in the process of growing up, and the market structure is changing a lot. You have new products, the ETPs that give mainstream investors access to crypto, and a much broader buyer base than you have had in the past. So the concept of cycles in crypto, the concept of seasonality in crypto, these are all things that we're going to need to rethink over time. I'm not honestly sure that any of those patterns from the last 5, 6, 7 years in crypto are still applicable to the market today. It's really a whole new digital assets market with new buyer base, new use cases, and new fundamentals to pay attention to. I would encourage investors to think about those fundamental drivers, which are really twofold. Macro demand for scarce digital assets due to downside risk to the dollar due to excessive deficit spending. And then on the other hand, regulatory clarity for the crypto asset class in the US, broadening the buyer base, making it easier for a much wider range of investors to access crypto. Those two fundamentals, macro demand and regulatory clarity, have been driving the crypto asset class this year. And I think that continues into the fourth quarter and beyond.
And you've argued crypto could be an alternative to the dollar. You were just saying that crypto is growing up. Is there enough institutional buy-in at this point? Is there enough regulatory clarity to make that case credible at this point?
Well, we're at the beginning part of that process. I absolutely think that Bitcoin, Ethereum, some other crypto assets have features that make them an alternative store of value. And there is huge demand for those types of assets today, whether it's physical gold or digital gold like Bitcoin. And the reason is not so much about gold or Bitcoin per se, it's challenges with the US dollar and other fiat currencies. We just have an enormous debt challenge here in the United States, which is compounded by the fact that interest rates are going up, interest expense is going up, and therefore we're on an unsustainable path for our debt and for the US dollar. And so the world's investors are looking for alternative stores of value to provide a ballast in their portfolios from the risk of fiat currencies. And cryptocurrencies like Bitcoin and Ethereum can partly serve that purpose. So we're not going to replace the dollar anymore that we're going to replace the dollar with gold. But there is absolutely a role in most investors' diversified portfolios for these types of assets. They provide a unique source of return and a ballast to some of those risks to fiat currencies. And that's why you see so much demand for gold, so much demand for many of these crypto assets today.
Now, Bitcoin and Ethereum dominate the market. I just heard you mention the two of them several times. Are there other types of tokens, though, that maybe should get a second look from institutions? Or do you think over the long term, we're going to be more concentrated in those two coins?
Well, absolutely, there is more that deserves a second look from institutions, but it can be an overwhelming space for many people. There are literally 50 million unique tokens in crypto today. So many things that institutional investors often don't know where to begin. And this is where Grayscale can provide some guidance. We have a framework, for example, that we call crypto sectors that divides the market up into distinct subsectors or industries, much as the way we divide the equity market up. And we use that to help guide investors through some of these choices. So whether they want to invest in decentralized finance or whether they want to invest in the AI applications of blockchains, we can help investors guide through that process. But yes, there's absolutely more to look at beyond Bitcoin and Ethereum. And a professional asset manager like Grayscale is one of the resources that institutional investors use in order to navigate their way through the space.
And when you look at the blockchain, beyond just crypto, beyond these altcoins, what other use cases do we have when it comes to blockchain technology? Because it's something that I've been hearing a lot about from even publicly traded companies.
Yeah, so fundamentally, this is about changing the way our financial system works. These are innovations in digital money and digital finance. And the kind of core innovation is that we can send things of digital value on a peer-to-peer basis without intermediaries in the same easy way that we send information on a peer-to-peer basis. So I can send you an email and there's nobody stands in the way of that. It's instant, very frictionless, but we can't send money that way in our traditional financial system. What the promise of blockchain technology offers is that we can send money, things of value like assets, on a peer-to-peer basis in just the same easy way that we send an email to each other. So that's sort of the core breakthrough in everything that we are building in crypto. You know, people know about stable coins, they know about tokenized assets, they maybe know a little bit about decentralized finance. Underlying all of those innovations is this really basic idea of peer-to-peer exchange of value, sending money as easy it is to send an email. That's what we're working on. It's going to take 10, 15, 20 years to realize that full vision. And investors that are investing in crypto today, this is what they're anticipating. Growth in that idea, adoption of these technologies, and really transforming finance along the way. That's the journey that I'm here to work on over the next couple of decades in digital assets. So it goes well beyond stores of value, digital gold use case. Those are important. Those provide utility to investors today. But really what we hope to do is transform how our financial system, our capital markets work from a fundamental standpoint. And that's the promise of blockchain technology.
That's some fascinating stuff. Zach, appreciate your time. Thanks for joining.
Thanks for having me, Allie.
All your market action straight ahead. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke Mama. We're live at the NASDAQ here in Times Square. Let's get a quick check on the latest market action. We're about 2 hours into today's trading session. We're seeing a bit of a divergence here when it comes to all three major indices, a bit of a mixed picture here. We have the Dow moving up about 0.4%, and then you have the NASDAQ on the flip side down about 0.3%, and the S&P 500 still around that flat line, bordering up and down about 0.05% this morning. And this is largely as investors digest the latest economic data. We are getting this morning a read. The PMI data, that's U.S. manufacturing and services sectors, grew less than expected in September. That's according to S&P Global's U.S. flash PMI reading. We also have Jerome Powell. He's set to speak about his monetary policy for the first time after that Fed meeting where they cut interest rates by a quarter point. That was the first cut that we saw in 2025. But all three major indices did see record highs yet again on Monday, now seeing this downward momentum in the NASDAQ. Let's take a closer look on the YF Interactive on what exactly is leading lower. After Nvidia invested $100 billion in OpenAI, we did see that stock move higher on Monday, and now in intraday trading today, we are seeing a bit of downward momentum, down about 1.7%. Also seeing a bit of a sell-off today, not really sell-off, but just downward momentum is Amazon. That stock down about 1.6%. Once again, this stock is in the red after it did see some downward momentum on Monday. We also have Microsoft, Google, Tesla all seeing red today. Netflix also leading downward momentum, down about 1.3%. And this is largely a flip side after we saw most of the Mag 7 in the green on Monday. I also do want to take a look at gold. We are seeing gold really see this momentum year to date after investors really seeking out some safe havens. We are getting calls on the street to reach higher price targets at year end. But really, this is the highest that gold has been since, I believe, and as for I keep saying on our air, since 1979. And as you can see, year to date, investors really have turned to gold amid all this volatility around monetary policy, tariffs, and so on. And gold futures up more than 40% year to date. We'll definitely keep a close eye on that. Also taking a step back after speaking so much about where we are cryptocurrency, we are seeing cryptocurrency roughly flat right now. Bitcoin trading flat, Ethereum flat as well after that really what a run up this summer that Ethereum has seen, up more than 100% 5% in the last 6 months. Once again, mixed picture here. We are seeing this divergence with all three major indices, the Dow moving higher, NASDAQ moving lower, and S&P flat. Keep it right here on Yahoo Finance for all the latest market moves.
Well, Citi Analyst Michael Ward just lifted his price target on General Motors to $75 a share. That's up from the prior 61 and implies about 27% upside from here. Ward saying that GM is highly exposed to trade deals, but has done enough to offset tariff pressures. Joining us now is the analyst behind the call, Michael Ward of Citi, who also has a buy rating on the automaker. So, Michael, let's start with your call there. What has GM done that's been able to really mitigate these pressures?
Yeah, a couple of things. First off, when they announced that they had exposure of $3 to $5 billion, they talked about the ability to mitigate about 30% of it. And they're ahead of the game on that. And there were three buckets they focused on. One was pricing, one was cost, and one was onshoring. The onshoring doesn't really kick in until late 26, 27, but some of it has already started. At their plant in Fort Wayne, Indiana, they made some progress. They're ahead of pace on the pricing front. GM is probably in the best shape in the market from a price standpoint. Right now, their transaction prices are about $5,000 above the overall market, and their incentives are $1,000 lower. GM has gained over a point in share this year. They've gained in each of the last 3 years, so they have a lot of product momentum. The only thing we did to up our target price was say that if we have a multiple range of 3 to 5 times EV to EBITDA, we've been valuing it at the low end of that range because of the tariff concerns. And I think some of that uncertainty or volatility has slowed, and that should be translated into the price of the stock.
Now, we have seen tariffs cut into these results, about $1.3 billion in the first half of the year alone. But you do argue that agreements with countries like South Korea and potentially Canada and Mexico could offset much of that by next year. So how significant are those agreements for GM's outlook? And what could happen if we do see an escalation of trade tensions?
Yeah, we don't want to see escalation of trade tensions, that's for sure. That's plain and simple, that's negative. But yeah, the South Korea deal, assuming it gets signed and if it goes retroactive, that's a bonus to GM of $800 million. So that original $3 to $5 billion target gets knocked down to 2 to 4. That's a plus. Canada and Mexico is the big one. And, from everything I've heard or seen in the industry, they're trying to tie together a trade agreement to re-upping the USMCA trade deal. And if that occurs, that basically is going to wipe away most of the other shortcomings that GM has, especially when you put it on to those three buckets on what they've done on the pricing front and what they're doing on the cost front and with the onshoring to the U.S. the way it stands. Assuming Canada and Mexico have a 15% tariff, yes, it could be wiped away by next year, and estimates are too low. And even the way we sit, we would have about $1.50 or $2 per share upside if those things occur.
And on the demand front, sales are strong, production's up, GM is getting higher prices with fewer discounts. So what does that say about the pricing power of GM relative to the strength of the auto market overall?
Yeah, first of all, on the strength of the overall auto market, I think one thing the market has completely missed is the impact of the millennials onto the auto cycle. I've been following the autos over 40 years, and right now the underlying demand trends based on demographic and the age of the vehicle fleet and replacement are better than at any other time in the 40 years that I followed the group. Auto sales are moving higher, much higher, over the next 3 to 5 years. And if you look at the millennials, that generation will have a bigger impact on our overall economy than the baby boomers did in the 1980s. And it's bigger and it stretches out over a longer period of time. The millennials are now in the prime age for home ownership and vehicle ownership. Those two kind of go hand in hand. So I'm very bullish about underlying demand trends in the U.S. market. You put on top of that the discipline the industry has with inventory, that gives, and what GM and Ford in particular have done, rebalancing their portfolio. GM and Ford really don't make cars anymore. It's limited what they produce, the Corvette, Cadillac, in the case of General Motors. And so you're getting a much higher shift in mix for General Motors and Ford into segments where they can compete, which is much more profitable. And so the industry is probably in the best potential shape for an upturn than I've seen it in the last 4 decades.
So does that maybe give you a little bit more confidence that just the sheer demand might be able to offset some of these tariff pressures?
Absolutely. No question. Demand and the consumer preference. If you look at the government data, the average consumer expenditure for a light truck is $15,000 higher than it is for a car. And so as you've shifted in the market from going 50-50 cars to light trucks to now 80-20 light trucks to cars, that has benefited the Detroit 3. It has benefited the mix in the overall market. And it's one of the things that accounts for the higher ATPs that you've seen in the marketplace.
And speaking of consumer preference, let's talk about the EV picture here too, because we did see the expiration of some of those EV tax credits. We know the infrastructure hasn't really been there. How do you square the EV side with some of these bigger automakers that maybe are a bit exposed on that front?
Yeah, and you do have to have some capacity realignment on the BE front. Remember, just a couple of years ago, you had legislation that was saying that 50% of the market had to be BEVs by 2030. Consumers weren't ready to accept that. If BEVs are in that much demand, why did you need the 7,500? Right, a simple question. So EVs are coming. They're not going to zero. Right now, they're at 8% of the market. I would say that over the next 5 years, it's going to go closer to 15%, not the 30, 40, 50 that people were talking about. But it is a use case, in a very specific use case. California BEVs are 20% of the market. And usually the saying goes, what happens in California, the rest of the country follows. So I do think BEV penetration is going to increase, but they're not for everybody, and they're not for every region. In my case, my wife has a BEV, and she loves it. She'll never go back to gasoline just because of the use case and the benefits she gets from it. So BEVs are coming, but just probably not as dramatic of a shift that people expected. In addition, people forget, in the early 1900s, 1/3 of all the vehicles on the road in the U.S. were electric. They're not new to the U.S. market.
Right.
But you're right. The infrastructure and everything else has to get rebalanced. You are getting products that meet more of a use case, like pickup trucks, smaller, cheaper crossover vehicles where people can really get a benefit, if they're commuting and those sorts of things.
And real quickly, we only have about 30 seconds. I know you have a buy on GM. What other auto stocks are you bullish on?
Dealers. Dealers are a great business. I always believe you follow the money. There's no bigger collection of wealth in this country than auto dealers.
All right, auto dealers. Mike Ward of Citi, thank you so much. Appreciate it.
Thank you for having me. Appreciate it.
We are navigating how to play the GLP-1 trade. Yahoo Finance's Miles Udland spoke to Evan Spiekerman, Managing Director for Biopharma Research at BMO Capital Markets. Take a listen.
Pfizer buying Metsera. Where is Pfizer in the GLP-1 race? Because to me, as a casual observer of what's gone on, I think Novo, I think Lilly. I don't really think about anybody else. Where does this bring Pfizer, within that context?
Great question, and thank you for having me. So a little bit of history. Pfizer had been working on their own small molecule GLP-1 drugs. Both of those were discontinued. This would have been similar to Lilly's orforglipron. And I could tell in my interactions with the company over the past year or so that they've been itching to be in the obesity space. Actually, a couple of years ago, I'd done a presentation at Pfizer HQ outlining the space. I could tell some enthusiasm was there. So this brings them, really brings them meaningfully ahead. They're still behind Lilly and Novo. But what I find very interesting about the assets from Metsera are that one of them is a once monthly GLP-1, so think Wegovy, but instead of once a week, once a month. They also have a drug targeting amylin, which after the European Diabetes Conference last week is the new hottest target. And 3, they have an oral version of their GLP-1 that, unlike Novo Nordisk's oral semaglutide, doesn't have what's called the food effect, where you don't have to fast before you take it. You don't have to wait a half hour before you can have anything after. So all in, brings them up, pretty meaningfully in the race.
Yeah, and I guess also in thinking about, you talked about how that medicine is administered. We have the shot that most people are familiar with. There's been so much development around the oral route. Where does that development stand? And it sounds like, maybe I'm wrong. It sounds like Pfizer is going to probably just try to jump directly to the oral route with this acquisition, or where are we at there?
I think they're going to do everything. I think they're going to focus. They talked about their sterile injection facilities, production facilities on the call that they had earlier today. So it's pretty clear to me that injections are important, especially if they're once monthly versus once a week. I think that'd be fantastic. Combining GLP-1 plus amylin in a once monthly shot, also very competitive. And to your point, third would be a daily oral, which for many patients might be perfect.
Now, let's turn our attention to Novo and just, I see that as the stock story. The share price feels like that's become a broken story just on their development pipeline. And it's interesting because, most people hear GLP-1s. Ozempic is the brand they associate with it. Right? You would think this is going to be positive for Novo. Where is that company in its efforts to kind of, correct the story and just get investors back on board, to where things were in, 21, 22?
Great question. And yes, Novo has been one of the leaders in this space, but they've really kind of lost their way over the past year and change, kind of missing cues from what the market wanted, whether it's DTC, whether it's higher efficacy with CagriSema. And so where they are now, they have a new CEO. A few weeks ago, he came on and is really restructuring things, cutting jobs, and that's always tough, but I really appreciate the focus. Looking ahead, by late this year, early next year, we'll have the approval of their high-dose oral semaglutide, an oral product, which would be like an oral Wegovy. We'll also have data for their drug CagriSema, which is their next-gen versus Lilly's Zepbound. What's also very interesting is they're looking at the use of semaglutide as an oral version to potentially prevent Alzheimer's disease. So they have a lot of stuff, but we need to see them refocus. And I think some investors are very, kind of tempted by the valuation disconnect between Lilly and Novo, but we're still on the sidelines as we think the fundamentals for Lilly are stronger than Novo at this point in time.
And then, Evan, quickly, I want to get you out on a question that I'm going to guess you are asked by investors, which is, talk about GLP-1s is all we talk about. What's the next, not GLP-1 medicine, but what is the next treatment for whatever condition that will be the next GLP-1s, let's say 5 or 10 years?
Oh, that is such a tough one because this is such a big market and we're so early on. Areas that I'd focus on still in metabolic disease, but looking at things like fatty liver disease, high cholesterol, and then still in inflammatory disease, there's a lot of what we call unmet need. A lot of folks that have psoriasis, that have various types of arthritis. There's still a lot of room for improvement of what we currently have, so I'm still focused there.
All right, Evan Siegerman with BMO Capital. Thanks so much for the time.
Thank you very much.
We talk a lot about the Fed's dual mandate, jobs and prices, but did you know that there is a third? Newly appointed Fed Governor Stephen Miron just raised it on the Hill a few weeks ago. And on today's Stocks in Translation, we're going to break down the Fed's 3 mandates and why they matter for your money. In the 1970s, Congress tasked the Fed with 3 goals. The first 2 are commonly known: maximum employment and stable prices, which the Fed interprets to mean 2% annual inflation. The third is rarely discussed, though. It's moderate long-term interest rates, and it refers to the long-term borrowing costs on Uncle Sam's debt. And for years, the Fed simply called it a dual mandate because moderate long-term rates are supposed to flow from good inflation control and strong employment. But that third line is written into law, and it's back in the conversation. Let's review a timeline of how we got these mandates, which are intertwined with Fed independence, the notion that the Federal Reserve should operate without influence from the White House. In the 1940s, the Fed helped keep long-term rates ultra low. After the war ended, there was a lot of pressure to continue, but it finally came to an end in 1951 with the so-called Treasury-Fed Accord. Then in 1965, President Johnson tried to get the Fed to once again lower long-term rates to fund the Vietnam War and his social programs. LBJ invited Fed Chair Bill Martin to his Texas ranch and reportedly threw him against a wall in order to intimidate him, but Martin held fast. Then in 1977, Congress finally codified the 3 mandates, which we already discussed. And fast forward to just a few weeks ago when Stephen Miron invoked the 3rd mandate as he addressed the U.S. Senate during his confirmation hearing for Fed governor. Shortly after that, the Fed cut rates, as expected, for the first time since December. And Yahoo Finance Fed correspondent Jennifer Schonberger asked Fed Chair Powell about the Fed's 3rd mandate at the presser following the decision.
We always think of it as the dual mandate, maximum employment and price stability, for a long time, because we think moderate long-term interest rates are something that will result from stable inflation, low and stable inflation, and maximum employment.
Translation: the Fed doesn't see a separate knob that it needs to turn for long-term rates. But if those rates get unmoderate, then politics could get loud and fast. So let's take a second and review why long-term rates matter. These affect Americans' borrowing costs for homes, cars, and business. They can affect stock prices as valuations, as well as projects that get funded with borrowed money. And they directly affect Uncle Sam's interest rate bill, which, by the way, tallied $1.2 trillion last year. And remember, when the Fed first started cutting rates in September of 2024, mortgage rates, they jumped for weeks. Long rates do not always follow the Fed. They follow supply, inflation risk, and investor appetites. And this is where the third mandate debate really gets real. If long rates surge, they tighten financial conditions, even though the Fed is cutting short-term rates. That can hit housing, tech investment, and as well as the federal budget. All of that at once. So here's what to watch out for next. Listen to rhetoric out of D.C. surrounding the Fed's third mandate from Myron, D.C. insiders, or even President Trump himself. Then watch that court case that will decide whether or not Fed Governor Lisa Cook can be fired by President Trump. If she goes, Trump could stack the Fed with more rate-sympathetic doves. We're also going to watch out for news from the Treasury about borrowing needs, which affects supply. And finally, watch the yield on Uncle Sam's 30-year debt. If it heads north of 5% again, that could ramp up pressure on the Fed as monetary policy gets tighter, even as the Fed cuts rates. Bottom line, the Fed's dual mandate may be doing the work, but the third is back in play. And if long-term rates don't stay moderate, markets and politics could force the conversation. And tune in to more episodes of Stocks in Translation. New episodes drop every Tuesday and Thursdays, which you can find on the Yahoo Finance website or wherever you find your podcast. Stay tuned for more market catalysts up next.
Americans are feeling the pinch of higher food costs, whether it's meals at home or dining out, and food service workers themselves are among the hardest hit. Giving Kitchen is a nonprofit stepping in to provide critical financial support for workers and their families. Joining me now is Chef Andrew Zimmer, an Emmy winner, 4-time James Beard Award winner, and a board member of Giving Kitchen in studio. Andrew, thank you so much for joining us today.
Thanks for having me.
So we are at this critical juncture, it feels like, in the restaurant industry. What's your bird's eye view? Where does the industry stand today?
Balancing precariously at the edge of a cliff. It's been harder to retain employees, harder than ever before. We're seeing increasing more and more closures than ever before. Some critics would respond, well, look at all the openings that are happening. But when you look net at job loss within the industry, state by state, you really get a much better picture of it. We also are underserving the people in the hospitality and food service industry. This is a group that's made up, it's a very special community, first-time job seekers, last-time job seekers, returning citizens coming from jails and institutions, single moms, single dads, new immigrants. I mean, we're either the number one or the number two employer of that special population. We're the third largest employer in the country, hospitality industry, food service industry. We need to do a better job taking care of those folks. We need to be grateful for them and, say thank you and acknowledge their contributions, but we have to be there to fill the gaps for those workers when they need help. That's what Giving Kitchen does. As an industry, I worry about restaurants. We've been increasing the tipping point from which these restaurants can go under, right? Fewer and fewer dollars. We know there's gender and pay equity issues. We know that there's employee issues. We know that there's a higher price to pay for food. Restaurant owners and operators are good people. Are there some bad actors? Sure, just like any other industry. But what's most important, I think, is that this is the lifeblood of Main Street. Restaurants is where we celebrate everything. And we need to do a better job, regulations-wise. We need to do a better job of solving the problems within our food system so that we can stabilize food prices, so that at least we can rely upon that.
And I always say everyone should work in the hospitality industry. I was a waitress for a few summers down at the Jersey Shore. I learned a lot about people. It was a hard work. You're on your feet. 2/3
of Americans have had a job in food service at one point or another. 2/3.
Yeah.
It's an incredible statistic, and I try to remind people of that all the time. I think one of the things that people don't understand is that with so many restaurants pivoting since COVID, with rents going up through the roof, with this inflationary period we're in, and I believe it's only going to get worse, with food prices on the rise, as restaurants become in a more precarious position, and you and I, let's say, own a restaurant, we say, well, we're going to, instead of being open Sunday, Monday, we're going to save money by closing Sunday, Monday. Well, those are shifts that our employees come to rely upon. And so every decision that's made in a restaurant has a fractious impact on the average food service worker. And that's where things like the Giving Kitchen Stability Network steps in. Obviously, if you break your hand in an accident at home or something like that, we can step in with financial assistance. But I think what is really, really important here to understand is that people in the restaurant business are working less and less. Costs are going up and up. Visits from the average consumer are becoming smaller and smaller and smaller simply because they're being pushed financially. It's not a good time for restaurants in America.
You mentioned costs going up. Tariffs have been a factor there, and we've seen tariffs filter through into the cost of food, both at home and at restaurants, dining out. So how are you seeing that demand picture shift as tariffs continue to work their way through the system and prices rise?
Well, people are looking for alternatives here at home, right? But I mean, I just give you a very large snapshot picture here. I live in Minnesota. The state to our south, Iowa, is sitting on billions of dollars, plural, of soybeans. 95% of the soybeans grown in Iowa were sold to two customers. USAID no longer exists, no longer buying, right? China, number one purchaser of those soybeans, right? They're not buying right now in a retaliatory effort to the notion of tariffs from this current administration. It's just a small snapshot that's going on all over America. We are subsidizing the farm to freighter economy instead of helping to subsidize specialty food crops, which are foods fit for human consumption by definition. It's an awful, awful thing. And I think one of the things we need very much, since hospitality and food and the entire bundle is such a massive part of GDP. I mean, just independent restaurants alone, 11 million employees, 6% of GDP. So it gives you an idea. We start to get up into the 20s when we have everything that affects food. I think we need to have a Secretary of Food, cabinet level position, and take all the decision making out of the 7 or 8 alphabet agencies in which those decisions lie. It's about time. And I think if everything was under one roof, we would be able to create legislation and make decisions that benefit everyone. I think regulations for things like food rescue, they're different in almost every state, make it impossible for someone who creates a solution in one state to have it replicated in another because the laws are different. We're trying to feed and take care of people, and I think people are losing sight of that.
And speaking of policy decisions, we have the immigration crackdown, the labor side of the equation. How is that impacting the supply and demand for restaurants?
Well, it's massive. I mean, there's fewer workers, right? Farmers are seeing fewer workers. Everyone is seeing fewer workers. You know, the immigration issue is not red or blue or left or right. This issue has been, immigration reform has been kicked down the road for the last 7 or 8 administrations, right? This is something that is so crucial to how work gets done in America. Remember, people come in from overseas, they work here for 5-6 months, they pay taxes, right? They're able to send money home, stabilize their community, one paycheck at a time. It worked and has worked for decades. So the more that we shrink these HB1 and 2 visa programs, the less well off we are, and I would argue the less safe we are. That's part of the international security impact of food decisions these days. So I would like to see visas, a different type of program enacted that allows for people to come in and work easily in farms and factories that are processing food, and yes, even restaurants.
And finally, I want to get your thoughts on tipping. We've seen the White House move to eliminate taxes on tips. Not all tips are included in that. And then in the background, you have a shift in the behavior for tipping, where it feels like every which way you go, you're always having to tip. So your general thoughts on how tipping has evolved?
It's a circular firing squad. Tipping as a system has an awful history, right? And it's an antiquated system. But what you also have is people in the front of the house who traditionally are making a lot more money than the people in the back of the house. Now, a lot of folks have argued that group is smaller, that group is oftentimes easier to schedule, et cetera, et cetera. But as we've seen post-COVID, not only has human behavior changed, resistance to tipping, but we've taken away the ability in many states through junk fee bills, like in my state of Minnesota, taken away the ability for restaurants to add a surcharge to your bill that simply goes to, let's say, we're taking 3% and adding it to your bill to pay for healthcare costs and to our, to lend a gratuity to our back of the house employees.
They do it in Europe, right?
100%. Well, that's a much more professionalized industry over there. And those employees, the regulations in one part of France are equal in the other part of France. When we talked before about regulatory issues, one of the biggest ones is that state to state, it confuses the consumer. Service charge in one state, a surcharge is A-OK. In another state like mine, Minnesota, it's not okay. We have to have a national plan, but unlike so many other things that we've seen roll out from this administration, it has to have incredible forethought put into this. Another reason why a Secretary of Food would be such an important thing. It's not just, an almost $1 trillion bill like the farm bill that includes SNAP. We're also talking about issues like this that would actually help support the third largest piece of our economy when it comes to jobs, and that's the food service worker.
Yeah, and you think taking an aggregate with rising costs and then the tipping and the inability to really add a surcharge, it all adds up for these restaurants. Right. Andrew Zimmern, great insights there. Thank you so much. Appreciate you joining us.
Can I throw in one more thing? Givingkitchen.org. It's the best place to take care of food service workers. And people, Food Service Worker Day is this Thursday, the 25th. 2/3 of America, you should post a little story about what it was like when you were working down on the Jersey Shore and hashtag it FSW Day.
I have many stories.
FSW Day. And go to givingkitchen.org. Your dollars help, but educating people in awareness really helps too. If you've heard something here today that makes you want to help support a food service worker, a simple act of gratitude helps a lot, and giving a couple dollars helps too.
Yeah, definitely. And I remember my days as a server. That always was very much appreciated. Andrew, again, thank you again for joining us. Well, all your market action straight ahead. Stay tuned. You're watching Market Catalysts. C-suite confidence is on the rise. That's according to the latest EY Parthenon CEO survey, which found that corporate leadership is very optimistic about business conditions in the next 12 months. That's despite 57% of leaders anticipating geopolitical and economic uncertainty to last for a year or more. For more on the findings in the report and what it means for investors, I want to bring in Andrea Gorzani, EY Global Vice Chair of EY Parthenon. Thank you so much for being here. I guess let's start with what's driving a lot of this optimism, especially as we just laid out at a time where there are a lot of uncertainties.
Thank you. Thank you for having me here. I think it may sound counterintuitive, but after so many months of uncertainty, what our survey is telling us is basically that C-suite is becoming more and more confident that they can actually manage the current level of disruption, being geopolitical disruption and disruption coming from the tech space and so forth. And they have to do this. And there is a clear sign towards the appreciation of the fact that this level of uncertainty is not going to go away anytime soon. So they need really to build their own resilience. And based on their strategies, they need really to find a way to become competitive again. And this is what's happening. So that's really the main trigger for this increase in the level of confidence.
And one of the biggest themes here is localization. 72% of CEOs say they see it as a longer-term shift. How are companies rewiring their supply chains and operations in order to be more closer to home and maybe insulate themselves from some of the larger issues out there?
And that is a great question. I think it's really about reducing the risk coming from operations that were built in a different world before what happened over the last couple of years. And it really comes down to building local markets, including all the infrastructures that are required for a company to operate closer to their customers. So building their own IT infrastructure, supply chain, and trying really to speak the same language of their stakeholders there, understanding better the regulations and ensuring that they comply with the rules of the game in a way that can only be done staying local and regional. And this is now, as the survey testifies, a long-term strategy. So the companies are investing in the long term to get more resilient and actually to secure their main markets by shifting their assets closer to the customers.
We're also seeing more deal making in this environment, particularly joint ventures, strategic alliances. Why are CEOs leaning more into partnerships in this type of moment in history?
Again, I think this is it's really coming from the complexities and that we have to deal with in these times. And M&A remains strong. I mean, if you look at the data over the last 4 months, transactions on average has been around $300 billion per month, which is a good level. But the survey is showing that the vast majority of the CEOs are looking more into more flexible, agile, less complex kind of combination. And joint ventures and alliances provided that kind of formula. So without entering into lengthy, expensive, and riskier kind of transaction, joint ventures can actually address a specific business issues faster and with probably a lighter level of commitments on both sides.
Now, big tech CEOs are making big promises to the White House around investment decisions. Is that partly strategy in the sense of there's a necessity to do that in order to operate in this environment? Or do you think that does reflect real priorities behind closed doors?
I think it's a real priority. I mean, if you look at the respondents in our survey, it's quite obvious that there is an overall optimism regarding the impact of emerging technologies and AI on the business. Now you can see that all these investments are really aimed at supporting business transformations, and the journey is still long, but it's quite obvious that without that kind of commitment and focus, and the businesses will lose competitiveness and market share. So it's sign of the time. I think it's very important that also the risk associated with the implementation of these technologies are managed, and this is quite clear from the answers of our respondents. But the two things need to go hand in hand, and it's unavoidable really to go forward in this evolution of our business models, operating models through business transformations.
Now, Andrea, fascinating survey results. Thank you so much. Appreciate it.
My pleasure.
Well, that's it for Market Catalyst. I'm Allie Canal. Thank you so much for watching. Tune in at 12:30 p.m. Eastern to watch Fed Chair Jay Powell's speech live. That's right here on Yahoo Finance.